The Relative Strength Index, or RSI, is one of the most widely used indicators in technical analysis. It helps identify overbought and oversold conditions, reveals momentum shifts, and gives traders clear visual signals. But to use it effectively, you need more than just the indicator. You need to understand how it truly works behind the scenes. In this video, part of our series, The Best Trading Indicators Explained Step by Step, we'll break it all down. No hype, no guesswork, just logic, structure, and real-world examples. Let's get started. Let's begin by adding the Relative Strength Index to the chart. On TradingView, click on Indicators, then type Relative Strength Index in the search bar. You'll see several results, including community scripts and custom indicators. Make sure to select the one listed under the Technicals category, as that is the official built-in version from TradingView. By default, the RSI uses a 14-period calculation based on the closing price. Once the RSI is visible on the chart, hover over the indicator name at the bottom left corner and click the gear icon. This opens the settings panel, where you can fully customize how the indicator behaves and how it looks. Now let's go over the full settings of the Relative Strength Index, starting with the Inputs tab. At the top, we have RSI length. This controls how many candles are used in the RSI calculation. The default is 14. Next is Source, which tells the indicator which part of the candle to use. The default is Close, meaning the closing price of each candle is used in the calculation. You can change it to open, high, low, or combined values like HL2 or HLC3. Then we have the Calculate Divergence option. When checked, it adds automatic divergence detection between price and the RSI. By default, it is turned off. In the Smoothing section, the type is set to SMA by default, with a length of 14. This adds a moving average line over the RSI itself, which can visually clutter the chart. At ComLucro, we prefer to disable this setting by switching the type to None. This keeps the RSI clean and focused, making it easier to interpret momentum without interference from additional lines. The BB standard deviation input is used only when applying Bollinger Bands over the RSI. It remains inactive unless specifically enabled. Under Calculation, the time frame is set to chart, meaning it follows the active chart's time frame, like 5 minutes, 1 hour, or daily. The checkbox, Wait for time frame closes, ensures the RSI is only updated after each candle fully closes. This provides a more stable and reliable reading. If you uncheck it, the RSI updates live as the candle is still forming. Lastly, under Input Values, the option Inputs in status line controls whether the RSI's value and parameters appear at the top left corner of your chart. It is useful to keep this enabled for quick reference. Now, let's switch to the Style tab. Here, you can customize how the RSI and its visual components appear on the chart. At the top, the RSI checkbox turns the main purple line on or off. Just below it, you will see the RSI-based MA, which is the moving average applied to the RSI. At ComLucro, we prefer to uncheck this option to keep the chart clean and focused on the RSI itself, without the added smoothing line. You can also customize the upper band set at 70, the middle band at 50, and the lower band at 30. These help identify traditional overbought and oversold zones. You can adjust the color, line style, and thickness for each to match your personal preference or improve visibility. The background fill, overbought gradient fill, and oversold gradient fill options control the shading behind the RSI area. These can help highlight key zones but can also be turned off for a cleaner visual. Under Output Values, the precision setting defines how many decimal places are shown. Keeping it on default is usually best, as it automatically adjusts based on the instrument shown on the chart. Finally, you can enable or disable two display options. Labels on price scale shows the RSI's current value as a tag on the right side of the chart. Values in status line displays the RSI value, and parameters in the top left corner for quick reference. Finally, we have the Visibility tab. This tab controls which time frames the RSI will appear on. You will see options for ticks, seconds, minutes, hours, days, weeks, and months. Each row lets you set the visibility range, such as from 1 to 59 minutes or from 1 to 24 hours. If a box is checked, the RSI will be visible when that time frame is active. If it is unchecked, the indicator will be hidden during that range. At the bottom, there is also a Ranges option. This allows for more advanced visibility control, but in most cases, you will not need to use it. With all these settings adjusted, your RSI is now fully configured and customized. In the next step, we will look at how the RSI calculation actually works. Now that we have covered the default settings of the relative strength index, let's take things one step further. To help you truly understand how the RSI works, we have developed a custom indicator that breaks down the full calculation right on the chart. It is designed to mirror the behavior of the standard 14-period RSI, but with one key difference. It shows each step of the formula clearly, so you can see exactly how the final value is built. On the right side of the screen, you can see the most recent closing prices used in the calculation. Each one is labeled from P0, which is the current candle, back to earlier bars like P1, P2, and so on. This brings us to the core of the RSI calculation. So let's walk through it step by step. Step 1 is to calculate the price change. We take the close of the current candle and subtract the previous close. This gives us the difference in price from one candle to the next. Step 2 is to separate that difference into gains and losses. If the change is positive, we count it as a gain. If it is negative, we treat it as a loss. Any values that do not fit are simply replaced with 0. Step 3 is where we smooth things out. We calculate the average gain and the average loss over the selected period, which is 14 by default. This smoothing is done using an RMA, a type of moving average that brings more stability. Step 4 is to find the relative strength, or RS. That is simply the average gain divided by the average loss. And step 5 is where we apply the final formula. We plug the RS into the equation. RSI equals 100 minus 100 divided by 1 plus RS. This gives us a value between 0 and 100, which is what we see on the chart as the RSI. At the bottom of the panel, you can also see the intermediate values: average gain, average loss, RS, and finally the RSI, which in this case is 42.85. This real-time breakdown helps demystify the RSI and shows exactly how the indicator responds to recent price action. It is a valuable tool for anyone serious about mastering momentum analysis. Now here is something crucial, and it needs to be said clearly. One of the biggest mistakes traders make with the RSI is treating it like a buy or sell signal machine. They see the RSI drop below 30 and assume it is time to buy. They see it rise above 70 and immediately want to sell. That is incorrect. That is not how the RSI works. The levels of 30 and 70 are not automatic signals. They are reference zones meant to highlight possible overextension, not to trigger blind entries or exits. Many traders lose money because they treat the RSI like a magic button. They buy just because the RSI is low, even when the market is collapsing. They sell just because it is high, even when momentum is still building. Using the RSI like that is not just risky, it is reckless. To use it correctly, you need context. You need to understand the trend, the strength behind the move, and how price behaves around these levels. Now let's be clear, there are many powerful strategies that can be built using the RSI, from divergence setups to breakout confirmations and momentum filters, and our channel has multiple videos focused on these strategies. But that is not the goal of this video. This video is about the foundation, it is about how the RSI really works, and the risks of using it blindly. Because no matter what strategy you use, understanding the math, the logic, and the behavior behind the indicator is something every serious trader must know. This is not optional, it is essential. And that brings us to something we'll repeat in every video of this series. Because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory. It's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty. When they treat indicators as if they guarantee success, that mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, let me share a powerful idea from Mark Douglas, one of the most respected voices in trading psychology. He once explained that many traders believe their system or indicator told them what was about to happen. But in reality, the market moves because of the conviction, or lack of it, between buyers and sellers, not because of any mathematical formula. He pointed out that most of the reasons we hear in financial news are just stories made up to sound logical after the fact. And this illusion of certainty is what makes traders feel betrayed by their systems, thinking the methodology failed them, when in fact, no technical method can predict what will happen next on a trade-by-trade basis. As Mark said, technical systems only tell you what's likely to happen over a series of trades, never the next single one. And just to show how unpredictable the market really is, Mark once told a story about a trader he mentored. This trader was an excellent analyst, one of the best Mark had ever met, but he struggled to execute trades successfully. So Mark advised him to focus on analysis instead of trading other people's money. The man followed his advice and became an analyst for a major firm at the Chicago Board of Trade. One day, the firm's chairman, an old-school grain trader, sat down with him. The chairman was skeptical about technical analysis and wanted to see how it worked. As they watched the soybean market move within a range, the analyst confidently said that the current price would be the low of the day. The chairman laughed, picked up the phone, and ordered the sale of 10 million beans, 2,000 contracts, instantly driving the price down 10 cents. Then he turned to the analyst and said, "If I can do that, anyone can." And that's the lesson. Sometimes it takes just one player with enough size or conviction to completely destroy your perfect setup. So, the next time you find yourself waiting for that perfect signal, remember this: it only takes one player with enough power to make your setup irrelevant. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge. How you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast, practical decision-making. The Wyckoff method, to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube.